Welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is the show where we talk about all your mutual fund investments and our experts answer your queries. But the topic that we're diving into is fixed income funds. Now, in the budget, it was expected or hoped that indexation benefits would be brought in for debt funds. I mean, nothing of that sort happened. In fact, there was indexation benefit removed for other asset classes, but that's a whole different story. The question that we're asking today is that looking at the recent changes, especially in capital gains taxation, looking at the changes that have not taken place in indexation, how do you view fixed income investments or fixed income funds? Does this make equity schemes or hybrid schemes, that is a blend between equity and debt, more attractive? We'll explore how all these changes affect post-tax returns, especially for those in higher tax brackets, and discuss whether debt funds are still a strong option and for which kind of investors. To speak more on this, I'm now beginning the conversation with Rushabh Desai, founder of Rupee with Rushabh Investment Services. I also have with me Santosh Joseph, founder of Germinate Investor Services. Welcome to both of you and thank you so much for joining us today. Rushabh, let me begin with you. It's, I think, a post that you put out that sparked this conversation and this idea. So let's, start with that. How do you look at fixed income funds in terms of how attractive they are post the changes which took place in capital gains tax and those that didn't take place in terms of what was expected in indexation? Where do you stand now on fixed income funds?
Hi, Tamanna. Thanks so much for having me on the show. See, to be very honest with you, technically speaking, there is no alternative to debt funds. Okay, today, debt funds still remain a very attractive product, for conservative investors, looking for lower risk. Okay, when any product has equity component, it increases the risk in that product. Okay, with no indexation benefit, of course, definitely the returns will be impacted, especially for those who fall in the higher tax bracket, because now directly the income is taxed as per your respective slabs. Now there are three reasons why I feel that debt can be a lucrative bet for the next 2 years. Currently the interest rates are in the peak range. It is around 7-8%. Second is that the interest rate cut cycle has not yet begun, which is expected to begin probably end of this year or maybe early next year. And third, we have already come under the JP Morgan's bond index, and from January 2025, we are going to come in the Bloomberg emerging bond index as well. So this will pump in a lot of foreign money in our Indian bonds. So all of this will definitely, give benefit for the existing bond investors from a mark-to-market level. Regardless, having said that, however, increase will be in the returns. Currently the YTM, the yield to maturity are of AAA bond yields are somewhere between 7-8%. Even if it goes probably 1% or 2 higher than 7-8%, the higher tax bracket people will definitely be affected the most. Okay, even if you're paying 30% tax, it is going to substantially impact the returns in the debt funds. Now, I see one very good alternative to this from a purely from a tax benefit point of view is the beautiful category called equity savings scheme, equity savings fund. Now, what this does is that these particular funds invest in equity, pure equity, arbitrage, and debt. Now, if you choose this product very wisely, if you see these products range, their equity portion can range from say 15% to probably 50-60% as well. So it is very important to choose the right product, the right conservative product. So if a client or if an investor chooses this product, say like between 15 to 25% in pure equity, the rest in arbitrage and debt, I think from a taxation point of view, this can be a wonderful product because these products follow equity taxation. So if someone holds these products, equity savings scheme, for more than 24 months, which is more than 2 years, they are going to be taxed long-term capital gains flat at 12.5%. So regardless, whatever slab you fall in, whatever income you have, these products will charge you flat 12.5%. But it is very important to keep in mind that the equity component, the pure equity component, should not go beyond 25%. So that is how it will be still beneficial for conservative products.
Okay, so the equity component should not go beyond 20% in any of the hybrid funds you look at. Santosh, this is a very important point. Do people need to review what their fixed income exposure is after the budget? And also, let's keep in mind what has recently been happening in equity markets, fair bit of volatility. What would be your take?
I think let's begin by addressing a very important aspect that fixed income has actually got no alternative. In fact, for long we were saying that equity will do well because there is no alternative to make good money and inflation beating asset. Likewise, notwithstanding the negative impact of taxation on debt funds and fixed income funds, I think even for fixed income, there is no significant alternative standalone for the risk category that you're referring to. So, while Rishabh was saying that you have to look at products which have less than 25% equity, that is true. But you also have to understand that even this 20-25% equity in a volatile market like this can be unnerving to people who are coming in it for the first time. Now, you compare even a 20% equity to zero equity in a fixed income fund from a year from now when the markets are going to be choppy, it will have material difference in the return of the product and also the way the customers perceive it. So therefore, I agree with Rishabh that the equity savings as a hybrid category where equity can be sub 20 or 25% range is good for an investor from a post-tax basis. But I think for an investor looking solely for stability, solely for capital protection, largely in terms of not losing capital, but preserving capital and having some kind of a stability and income combined into an investment, you still have to fall back on the fixed income or debt funds. Now, not to forget that within that, there's a wide range from ultra short term to liquid to even corporate bonds and gilts, where again a play on duration or play on interest rate cycle could be beneficial, notwithstanding the impact of taxation.
Okay, so now if you want to sort of look at what's happening right now and basically have a little more conservative approach. Rishabh, let me come to you on this point. I understand that with the long-term capital gains tax changes, with the lack of indexation, debt funds have become perhaps less attractive. That's why you're saying hybrid. But if I wanted to be a little bit safer, considering that there is more volatility right now, what are the best kinds of fixed income investments I can make?
Tamanna, see, I agree what Santosh had to say that if see again this equity saving scheme is purely from tax benefit point of view, and someone would require higher yields. So even though when I say that it can be a good bet for conservative investors, as Santosh correctly said that even a 15-20% equity exposure during a massive drawdown in the equity markets can hamper these products. Okay, so it's very important to keep in mind that when someone enters an equity savings fund, they should have a minimum time horizon of around 3 to 4 years. Okay, if someone is having a time horizon of say 1 year or probably 2 years, then probably this is not the right category to go into. Now, as mentioned earlier also that debt funds will be beneficial from the following reasons, which I just mentioned earlier. I think today, if someone wants to take a conservative bet in debt products, I think corporate bond funds with an average maturity of probably say 4 to 6 years would be a good bet. Banking PSU funds again between average maturity of around 4 to 6 years, and some tactical allocation can be given into long duration GSEX funds. So again, let me put it very straight that for safety capital preservation, of course, then venturing into the debt space makes more sense. But if someone wants a little bit higher yield, someone can take little higher risk, like kind of an FD plus kind of returns, then equity saving schemes can be a good bet, Tamanna.
Okay. What do you feel about equity saving schemes, Santosh, if you do not need this product for tax saving?
You don't necessarily look at it from a tax saving perspective, and if you have a slightly extended viewpoint, Now, for many people, equity savings is their first step towards venturing out into equities. They do not or cannot afford the huge amount of volatility that equities give them. So, an equity saving, and especially the category that we spoke about, that was having a low equity exposure. Back in the day, about 10 odd years ago, we used to call them the MIP plans, but today they've rebranded themselves as equity savings, where the exposure to equities between, let's say, 15 or 20%. For an investor who's got the time, who wants to better fixed income and wants better post-tax income, it's still a good option. But remember, it comes with its own risk in terms of time. It's not going to be a plain vanilla debt apple to apple comparison. If you want to do better than debt, and if you have the time frame and you can stomach a little bit of volatility, equity savings is definitely a way superior alternative to standalone debt.
It's that part of the show where we take your queries, and if you want to reach out to us, you want our experts to answer your questions, well, the number is on your screen. Let's start with what Hemant has to say, age 32. Hemant asks, are gold ETFs cheaper now, and is it a good instrument to play the rate cut theme over gilt for the next 2 to 3 years? That's very interesting to ask about gold. Gold has seen a lot of volatility as well over the last few days. There is a crisis, geopolitical crisis simmering in the Middle East. Will this have gold prices back up even further, or will we see a bit of a slowdown right now? Either way, are gold ETFs cheaper now, and is it a good instrument to play is the question. Rishabh, let me come to you first with your response.
Tamanna, see, gold has fallen in the domestic market. If you see the global prices of gold, they remain elevated the way they are. See, mainly in the domestic markets, the gold has fallen because the finance minister has cut the customs duty on gold. But I would still bet on gilt products from a 2 to 3 year perspective over gold. See, although gold prices are expected to be elevated for the next 2 to 3 years, because what happens is that, number one, we are facing a lot of geopolitical crisis globally. So a lot of money will come in gold, which is a safe haven. Number two, central bankers globally are purchasing gold left, right, and center, especially China. So, and third is that, when the interest rate cut cycle will begin, I think more money will come in gold. But again, see, gold has already factored in a lot of things and is already trading at some decent elevated levels. So I don't think gold will probably go aggressively higher, maybe at a moderate pace. But I think I would still choose gilt funds from a 2 to 3 year perspective to play the rate cut bet.
Santosh, what would be your response to Hemant's query?
It's an interesting question because you're comparing two different asset classes. Of course, gold is a little cheaper domestically, but I think the Hemant should clearly know that one is gold and one is GSEC, and in one you're betting against a softening interest rate. On the other hand, gold is at least seen as a lot more stable for investors like these. So I would suggest that please understand why you're making this investment. While from a return perspective, there looks like gilts can really give you a nice upside, considering that we're in a softening rate regime. But some of us also have these liking for gold, or you want to hedge some part of your portfolio. So purely, it's a discretion of the portfolio. It's two different asset classes. I hope Hemant understands the benefits of both.
Okay, so which one would you prefer? His question is, are gold ETFs cheaper now? And is it a good instrument to play rate cut theme? You're saying the question is a little confused because they both are
No, I think
points.
I would go with gold, though the other option is quite tangential. I'd still go with gold because I think there's enough of opportunity, I believe, even in gold, especially with the depreciating rupee and the volatility that we're seeing globally. Gold may be a nice hedge to the overall portfolio and also may give you some decent upside.
Okay, Sadat writes in, age 54, says, I've invested 8 lakh rupees recently in a Bajaj multi-asset fund. This is my first foray into mutual funds. What should I do? All right, Sadat, thank you for your question. Santosh, I'll come to you first. It's his first foray, 8 lakh rupees in one particular fund. What would you advise Sadat?
I think Sadas has started off on a good note because today, in the present context that we are, multi-asset funds are a good way to start. Like I said earlier, that for a conservative investor, equity savings would be good to start. But for an investor looking to participate in the growth and not sure how to build a portfolio, he does not have help, multi-asset funds are a great opportunity because it helps you get the benefit of more than 2-3 assets. Number two, it also helps you navigate between when to reduce exposure to equity, to gold, to fixed income, to international assets. So therefore, I think it gives you a well-rounded portfolio. I would say good start. But as your portfolio and even your experience, or maybe even the surplus funds that you have grows, you can maybe add a multi-cap or a flexi-cap or whatever your risk reward appreciates for you. You should add that. But to begin with, I think he's done a good job by starting off in a multi-asset fund.
Okay. What should be the next step then for Sadat, Rishabh? What would you advise?
I think, diversifying a little bit, makes more sense because he's concentrated on only one product. So I think having 2 or 3 products probably of the same category or also dynamic asset allocation funds would also be great. See, one drawback multi-assets fund do have that because they have multiple asset classes in one product. So the fund manager needs to take very precise calls. So if the call goes wrong, then it can take a little bit of a hit. And also, since these products do have 3-4 asset classes in one, so what happens is, see, currently all asset classes are doing great, whether it is equity, debt, gold. But what if, say, like 2 or 3 asset classes don't do well? So this product can be, I won't say volatile, but this product can be little cyclical comparatively. So I think number one, diversifying in different products makes more sense, and also thinking about dynamic asset allocation funds is something what I would recommend.
Okay, let me go across to the next question coming in from Anand, age 32, says, I've invested 5,000 rupees a month each in the Tata Tourism Fund and Motilal Oswal Manufacturing Fund. Are these good bets? Thank you so much for your question, Anand. An interesting question there because both of them are thematic funds, very specific kind of investments. Rishabh, this is an area which has been very popular in the recent past. First of all, do you think a thematic fund is a good idea? And what about these two specific funds that Anand is asking about? That's the Tata Tourism Fund and the Motilal Oswal Manufacturing Fund.
Tamanna, we saw more than 66,000 crores of money coming in the NFO segment, especially sectorial and thematic funds. See, what happens is that, from a business point of view, AMCs are taking out or introducing new funds because the markets is good. We are sitting on plenty of liquidity. See, currently, let's look at the underlying facts of the markets as well. It's good to see the sentimental drive or the markets. We all want the markets to go ahead, but it's also at the same time very important to look at the facts and figures of the underlying market. See, currently markets are very expensive. Tourism sector and manufacturing sector are trading at a very high premium. Now, these two being sectorial / thematic products, will be very cyclical from time to time. They will perform in cycles. Okay, they are not going to perform in a straight linear direction. Okay, so if Anand is taking tactical bets, entering at lower valuations and then redeeming when the valuations become expensive, then from a tactical point of view, okay, you can take sectorial and thematic bets. But from an SIP point of view, I would still bet on diversified funds rather than thematic and sectorial funds.
All right, so be diversified rather than thematic from an SIP perspective. Santosh, your quick take on these two funds?
I think I'd go with what Rishabh said. I think Anand has just got carried away with the hot sectors in the economy right now, or the hot funds that are doing well. Though, when you look at it from a layman's perspective, being in tourism, being in manufacturing, all seems to be striking off the right notes, but this is not good for long-term portfolio and wealth creation, especially if you're starting off an SIP. You're way better off in diversified funds and avoiding these kind of thematic and sectoral funds, because these themes and stories tend to unwind also as quickly as they run up.
That's an important thing, that maybe from an SIP point of view, and depends on the rest of your portfolio as well, Anand. If this is all you've got, then maybe diversify. If this is something that you can bet on, then that's a different question. Tyagarajan writes in, age 61, says, started investing after the budget and have gains around 3% in PSU funds. Should I hold or sell? All right, Mr. Tyagarajan, thank you for writing in to us. He has started investing after the budget and in PSU funds has already seen a gain of about 3%. Interesting question. Santosh, I'll let you field this first.
Well, it's interesting for this question to come up because it's just barely a few weeks since we had the budget, and to think that you want to decide to quit or to continue itself is just telling of the present market scenario. So my humble request to you is that especially when you made an investment in a sectoral thematic idea like PSU, one would have to really give it a long runway. And considering that this is the first fund that you made investment, I'm given to understand that you must have at least thought about it before making that investment. Otherwise, thematic and sectoral, please give it sufficient time, at least a 3 to 5 year horizon, and don't worry about how the markets perform in the short term, like in weeks or months or maybe even in 1 or 2 years, because markets can go either ways. In the 3% positive can grow higher or even go lower, because one really cannot predict how markets function in this extremely short term. Please think long term. It's good that you've invested. Stay put and maybe stay for longer. Next time when you want to make an investment, avoid being in sectoral or this kind of thematic ideas. Be in a little more diversified instruments. Considering your age, I think you'll do better in a well diversified multi-cap or flexi cap.
We have very little time, so I'm going to take one last question very quickly. Jaipal, age 31, says, I want to invest 10,000 rupees in an SIP, each in 4 fund houses in multi-cap schemes and 1 ELSS fund for 10 years, planning to spend 50,000 rupees a month for 10 years to accumulate 1 crore. After that, I want to withdraw 1 lakh a month through SWP for 20 years. Is it a feasible goal? First of all, Jaipal, congratulations on having such a clear plan for the next decade or so. Rishabh, what do you think of the plan?
I think the plan is fantastic, Tamanna. Getting into multi-cap funds, which is a combination of large, mid, and small cap, and plus, of course, ELSS, which follows a flexi cap strategy, I think is a good bet. He's thinking about diversification also and not concentrating towards 1 or 2 products. So towards multi-cap funds and ELSS, I think it's good to go. Coming to his very specific goal of 50,000 rupees per month for 10 years, he will surely accumulate more than 1 crore of rupees. But coming to his SWP for the next 20 years, pulling out 1 lakh rupees is going to be a tough job. He will definitely run into negative balance, probably in the mid of the journey. So I think he's able to pull out anywhere between 30 to 40,000 per month. If he wants to pull out around 1 lakh of rupees, then of course increasing the SIP amount from 50,000 to probably say 75,000 or 1 lakh rupees will make more sense.
Okay. All right. So that's the advice for you, and great that you are planning up ahead. That's all the time we have on the Mutual Fund Show today, but the numbers on your screen if you want to write into us. We'd love to hear from you. Tell us what you think of the show and what are the kind of topics that you want to see discussed as well. We're always listening. But for now, thank you so much, Rishabh. Thank you, Santosh, for joining us. That's all the time we have. But stay tuned for more to NDTV Profit.